Hello everyone, thanks for watching. Today I'm going to give a presentation of a way I like to analyze an equity before its earnings using the long duration bond, but kind of on a relative value total return basis. So first of all, earnings are relative to cost. They're not absolute. So one of the things you learn when you're getting into finance, earnings per share, debt metrics, et cetera, and so on, it's fine, but you're starting to learn when you actually get into trading earnings that those are sometimes just numbers. You will see good numbers sell off, bad numbers rally, and sometimes it's not even narrative. Like people say, oh, earnings miss like this, but there's a narrative going on, but that's not always the case. Shares of the company are by definition an impact of the cash flow. And the mindset you have to have is what is the real cash flow? That is the corporate debt on a security. So once you take the lens off of just pure fundamental analysis or textbook economics or even narrative based trading, and you think structural, you think of the corporate debt on a firm, you start to get the actual structural institutional lens of how you need to see earnings. You look at it through the transmission of how does earnings affect your total return of that debt. So what we have here is we can say earnings are noise. I hate to say it, but to some extent, earnings are noise. Now, for fundamental analysis and firm analysis, you can still get excellent information out of it. So, earnings are noise is not me to say that they're not useful. They're extremely useful. But if you're creating a position 15 days to expiry or less, it is like it becomes almost Gaussian trying to guess it. But the P&L for like true total return on a firm is felt on the balance sheet in the firm's debt. So what we want to look for is a hedge adjusted total return, not just yield. Because we're looking at balance sheet constraints of institutional holders, we don't look at just yield because that doesn't determine everything. We want to look at factors such as hedging costs, the trading cost of the bond, even special repo. So the formula I use to get the total return financing yield kind of is the corporate yield minus the cost of the bid ask minus the hedging of duration cost minus the hedging of credit cost and subtract finally the special repo on the bond. So we're not just going to use dollar repo or SOFR. We're actually going to be looking at the special repo on that specific security. So this is just an image. You could see if you could have a 200 basis point yield on a corporate bond, but now bid ask costs 50 basis points. That's extreme, but I'm just making an example here. If bid ask cost is 50 basis points, duration hedging cost is 120 basis points, credit hedging cost is 80 basis points, and the special repo is 70 basis points. Now these aren't like exact numbers; they'd look a bit different. You can see the total return with my model here. Now this is just my formula. This isn't like a textbook thing. Would actually be a negative carry of 120 basis points. So that's kind of the metric you'd be looking at. And you want total return as a relative value observation, not just a single variable. Corporate yields are not observed as a spot. It's a complex total return, but then that's a complex total return relative to its family. For instance, if you're looking at a BBB plus bond and you're doing the total return metric, you want to look at how that performance on the balance sheet compares to the BBB index, such as a Bank of America index. Now, there's different ways you can do it. If you have a sophisticated bond desk, which you probably already know this information, if you do, you could simply break down all the bonds in there, create total returns on them. But if you are just a smaller prop firm or just a trading shop that doesn't need that level of depth, what you could do is for special repo, you could just look at SOFR plus credit. You could just look at the credit default swap index for that rating, and you could use just a duration approximation for the index, and you can actually create a total return index for that credit rating even if it's not exactly on the point, which is accurate enough to be used for relative value math. So here, this is just showing observed total return is a relative value concept. Number one shows if you have a deep bond desk, you could pair it against other bonds kind of in its sector and rating. But this is what I do, like with my own information, is I make an approximation index, kind of using Bank of America indexes, SOFR plus credit, and a bunch of approximations from swaps indexes. And why do I want long duration now? This strategy can work with any bond within the corporate curve, but I picked the longest possible duration. And first of all, that's because it's more sensitive to growth, global inflation, liquidity stress, and equity narratives. That's a lot of noise that some commercial paper advocates would say it can mess up the metrics, but modeling the noise around earnings season, especially if you're a volatility trader, is kind of what you're looking for. And secondly, the longest duration typically has the most cash flows within it, so that also makes the math easier to work with. And you can see in this image, it's just showing it's a very sensitive, that longest duration is going to be very sensitive to a lot of variables that you won't see as much on the front end of the corporate curve, and it typically has the most cash flows. So this is the final point, but analysis shows the total cash flows return typically doesn't lie. If you're trying to analyze earnings season, there's memes, there's narratives. It can feel like a roller coaster. You can get dizzy. Sometimes even doing the fundamentals analysis is secretly just making an iron condor with strikes you like and post hoc justifying it. But the most honest metric in the room typically is that hedge-adjusted total return of the company's debt, because it reflects a lot of variables and it reflects actual cash flows and actual P&L of institutional balance sheets. So that's going to be the structural analysis. And equities after earnings will typically reflect the true cash flows on there. So even if earnings are excellent, if there is a more negative carry after the earnings fall out on the debt, equities may reflect that. Now, people may post hoc say, oh, the narrative showed this was too good, but typically that is about as accurate as chart technical analysis voodoo. What's really going on, I'll go back to that previous slide, is there's a more negative carry, so people borrowing at the special repo and hedging to hold that debt can see their total return P&L start to dive, and the equities, which are a share of that cash flow, would reflect that. And this is the final image. You can see earnings season is, in my opinion, the most stressful as a trader time to do anything, because you just never know. Realized vol will have like micro black swans all the time, but the most honest metric in the room, it reflects a skew of variables. It's the true impact on a balance sheet. It's not just reflexivity. There is reflexivity baked into it, and you can measure relative cash flows, which is that total return relative value math. So you can kind of see if you're just following earnings season's noise, it may turn into building an iron condor and post hoc justifying. But if you're taking a structural analysis of the debt, you're taking these data-driven things, which you can translate over to directionality and what you believe to be the proper range of that earnings. Maybe is vol pricing it properly or not. Anyways, thanks for listening. That's just my quick presentation that I go over a way I use long duration corporate debt to help me manage the anxieties and general noise of earnings season. Have a great rest of y'all's day.